Hi there, Charles Goddard here. We're going to talk a little bit in this mini video about pyramiding, and it's got a bit of controversy to it. Essentially it means adding more positions as the trend is strong, and there's a lot of people poo-poo this strategy. But what I want to do is show you how you can keep the risk to the same as if you had one position, but you've got the advantage of two, three, or four positions. We discussed this quite in depth in the classes coming up because it is an important concept for you to get. Just before we get really started on this little video, it's only going to be a few minutes. So there's me. You can see my designations. Took a lot of sweat hours to get those, and also a lot of money spent in the company of long-term traders, guys that worked in the famous pits of Chicago and so on, learning that you've got to put practical together with theoretical, and that's what I bring to the table for you. So let's get down to it. As you know, we're always sort of probing, taking our trades as little probes, and then if you have no idea when you first place a trade, you hoping you're going with the trend, which is what I teach, and you hope that trend will be strong, and if that is the case, then we have usually in a trend that is we have an opportunity to add to a position. So let's take a look at an example of that, and we're going to use the same Apple slide that we did in the placement of stops. And we're going to take a look, and I'll try and convey this in a couple minutes. So here we have our initial trade, and we've got our stop down here, and the trend continues up. Well, that's a nice job of drawing by me. And right here, you can see we get a little pushback, and but not enough push to anywhere close to stopping us out. But it's at least 25% of the move so far since we got in. So to me, and like I said, I'll give you the parameters more in depth in the class if this is of interest to you. So we've got enough of a pushback here. Now here's the characteristic that I'm looking for. So we've got, it's as though we've coming on this chart for the first time, and we are right at this point, and we can see, okay, we've got a signal that's occurred right here that that tells us that the trend may be continuing. We know that stop buys have built up just over this resistance level, and we want to be part of that. So the resistance gets broken by this candle, so we are in somewhere right around here, and our stop is going to go right here at the red line at 87.87 or 88.87, whatever that is. But most importantly, what we're going to do is we're going to bring the stop on our first position up to this point. Now, so here's our net result. We now have two positions, and the first position is now risk-free because our stop is well above our purchase price, and not only is it risk-free, but we have also solidified with that stop our profit on that first position. So once we get above this candle and we're into our second position, we have two positions, but we only have the risk of one position, but we've got two positions carrying on up to the denouement at the top, which we covered in the stop. So now we're going to take a quick look at the math of this. Okay, so I know you didn't expect math, and I didn't either, but well, yeah, I did actually. So here's the math of the situation. We're going to assume $100,000 portfolio just to keep my math easier. And position one, per our process, is going to be 10% of that portfolio, and the share price we're buying at is 73.29, and it's rounded to 130 shares. Our stop is at 58 29, and if we multiply the risk, which is purchase minus stop, is $15 times 130 shares, we get a risk of 1,950, which is lower than the 2% risk to the portfolio that we never exceed when we're placing our trades. And I go into that a little more in the class as well. Now, the position of our trade has gone on up, and we got that pushback I mentioned, and we entered trade 2, where we looked at it in the same way. $10,000 divided by the purchase price equals 94.099, and we rounded that to 95 shares. The stop at 87.83 means that the risk is $18.44 per share times 95 shares equals a risk of 1751.80, which is again less than 2,000, and so we are good to go. And if we had, if that was higher than 2,000 by more than a few dollars, we would have adjusted the number of shares that we purchased. The same with position 1. We don't want to be above $2,000. There's no need to be silly. If it's $2,020, fine. Anything over $2,050, I would adjust the shares, and the same with position 2. So we've got our 2 positions, and we are stopped out per our first video at 119.11, and so we had 130 shares from start to finish. We made a profit of $45.82, totaling $59.56.60. And for second position, we had 95 shares with a profit of $31.28 at $29.71.60 profit. So the total gain is $89.28.20, and that is 8.92% over 4 months. And that is, here's the key. Here's the key. Number one, we're not going to extrapolate that over a year. I find that is a really phony accounting. It assumes that we could keep going with that production of return for entire year. It means there's nothing of the sort happens like that in trading. Averages and that kind of extrapolation is a waste of time. This might be our only trade. This might be the only trade where we make money. So we just say, okay, we made 8.92 gain over 4 months. Good for us. We never risk more than 2% of the portfolio, even better. But here's the key. Here's the key that, and if you read any W.D. Gann, you know he says this. You only need 4 or 5 good trades a year to make a really good return. So now you think about this. So you have a lot of probing trades, you're in and out, and let's say you break even on those trades, and then you have 4 or 5 trades like this, that where you've got 2, 3 positions, and you end up with 9, 10% each time. That's 4 or 5, that's your 40 to 50% return, and you have kept your risk to a minimum. Like seriously, how good is that? So we'll go through that a little more in depth in the class. So we're at our startling conclusion. Like I said, this is just a mini information video, and I'm not going to belabor some of the points. You can be berated at the workshop. Essentially then, the pyramiding is a big part of what we do. We look for the big move, we probe for the big move. We have no way of knowing when we first enter a trade, are we going to get the big move, or are we going to get stopped out? And we just follow our same process. If we have an opportunity to pyramid again without risk, and I'll show you the key components of that, then we're going to do it, and we will take 2 to 3 positions. You usually don't get more than 3 positions in a big move anyway, but it makes all the difference. So you can see the details here for the next workshop. You may need to cut and paste that link, but I hope to see you there, and we'll expand on this topic. Take care of yourselves, and hope to see you soon. Bye now.